Welcome to the Gap Advisors and ACE Clinic. We're doing a really special deep dive today. Usually when we talk about a diagnostic process, like say in the medical field, there is this baseline expectation of, well, mechanical precision.
Right, absolutely.
You know, you suspect a broken arm, the tech runs the x-ray, the image shows a jagged white fracture line, and the doctor points to it. It's clinical fact. The whole framework is designed to eliminate ambiguity.
It's a binary system at its core.
Right.
I mean, broken or intact. We find a lot of comfort in systems that make the invisible visible, right? Categorized by these universally agreed upon diagnostic codes.
Yeah, exactly. But the moment you pivot into financial reporting, specifically looking at the audited statements of publicly listed companies, that sense of mechanical precision can just degrade so rapidly.
It really can.
You're suddenly looking at a diagnostic landscape that is frequently obscured. The x-ray machine itself might be working fine, but the tech, the doctor, and the hospital admins might all be using entirely different criteria for the exact same image.
Or, as we're going to explore today, they might just be ignoring the mandated diagnostic manual altogether.
Right. And that brings us to the core mission of today's deep dive. Today, we are taking a massive magnifying glass to the actual published financial statements of a listed company.
We are. And we're going to dissect a critical accounting discrepancy that is amazingly just hiding in plain sight.
It's right there, codified directly into the accounting policies they published for their shareholders and the regulators.
The audacity of it is what makes this such a fascinating case study. I mean, we aren't hunting for some subtle estimation error buried deep in the footnotes.
No, not at all.
We are looking at a structural failure in the primary financial architecture of the entity.
So let's talk about where this comes from. The source material for our deep dive today is this really exceptional piece of forensic analysis. It comes from an independent suo motu review conducted by Gap Advisors. Specifically, this observation was featured in the 236th edition of the Gap Advisors Task Weekly newsletter. And that newsletter is authored by C.A. Manish C. Iyer, who is the director at Gap Advisors, and he publishes it regularly on LinkedIn.
And, you know, just for context on the depth of that resource, there are over 230 editions of this newsletter published to date.
Wow.
Yeah. The consistency of these suo motu reviews really provides a real-time pulse on the actual state of financial compliance out there.
So if you're operating in the finance space and you are on LinkedIn, subscribing to that newsletter is just a zero-cost, high-yield resource. You have to check it out.
Highly recommend it. But before we deconstruct the mechanics of this violation, we do need to establish some ground rules for our analysis today.
Right, the disclaimer.
Exactly. The views expressed in this deep dive are purely the personal views of the author based on his independent analysis of the source material.
Yep.
These views are not binding on anyone. We always urge you, the listener, to seek the counsel of a qualified professional expert before taking any financial action or refraining from any action based on the architectural flaws we're discussing today.
A super vital parameter to set. So, looking at the framing of this discussion, the immediate question for an analyst, or really anyone listening, is why are we doing this? Why allocate the cognitive bandwidth to dissect a single company's specific accounting routing error?
Well, because if you're deploying capital, if you're investing your hard-earned money in the shares of a listed company, mastering these accounting standards is basically your ultimate superpower.
I love that. A superpower.
It really is. It's the only unfiltered lens you possess as an investor. You know, financial statements are the empirical output of management stewardship.
Right.
A deep fluency in the accounting standards lets you reverse engineer that output. It helps you make proper, informed decisions on whether to buy, hold, or sell.
Because otherwise you're just trusting their word.
Exactly. Without that fluency, you're relying entirely on the company's investor relations narrative, which, let's be honest, is inherently biased.
Okay, let's unpack this. We need to lay the groundwork for the specific environment we are operating within today. The reporting period for the financial statements under our microscope runs from April 1st to March 31st.
Which perfectly aligns with the statutory financial year in India. Furthermore, the functional currency and the presentation currency for this entity is the Indian rupee, or INR.
And that distinction regarding functional currency is super critical, isn't it?
Oh, absolutely.
Because it means any transaction in USD, euro, yen, whatever, must be treated strictly as a foreign currency transaction.
Precisely. Establishing that functional currency is step one, because any other currency is foreign, and that brings in a whole other layer of translation mechanics.
Right. Now, the regulatory framework governing this specific case study is IND AS, the Indian Accounting Standards. But let's look at this from a global perspective. For the listeners outside of India or folks managing global portfolios, does this hyper-specific IND AS rule even apply to the rest of the world?
It translates flawlessly.
Really?
No difference.
Absolutely no difference. While the specific response from Gap advisors is framed under the IND AS architecture, there is zero daylight between IND AS and IFRS, the International Financial Reporting Standards, on this specific topic.
Oh, that's huge.
It is. IFRS is the global reporting framework for over 140 jurisdictions. So if you are dissecting financial statements under IFRS in London or Toronto or Sydney, you can apply this exact same logic. The regulatory mandate is identical.
That's amazing. Okay, I want to highlight a resource mentioned in the source material that is just, well, it's a game changer for this kind of scrutiny. Gap Advisors maintains this massive issue repository on their website, gapadvisors.com.
Yes, the repository is genuinely impressive. We're talking about a database hosting over 4,500 issues and detailed responses covering IND AS and Indian GAAP.
4,500 distinct application issues. That represents a massive cross-section of the actual ambiguity auditors face in the field every single day.
And the best part, it's not locked behind some crazy enterprise paywall. Any person can register for free, submit their complex application issues on IND AS or Indian GAAP, and get a detailed response delivered directly to their inbox.
It's incredibly useful.
I mean, think about an auditor who needs to meticulously document how they addressed a specific application issue. Having a centralized expert repository to validate their interpretation is a massive advantage.
It really bridges the gap between the theoretical standards and the reality of practical application.
Yeah.
Plus, if you need more than just a written response, you can actually book a one-on-one consultation on your IND AS and IFRS issues directly with the author, CA Manish C. Iyer, from his page on topmate.io.
Which is such a great escalation path for the really opaque reporting dilemmas. Okay, so now that we understand why these standards are the universal language of business health, let's pivot to the specific medical rule our listed company is accused of breaking.
Let's do it.
We are focusing our analysis on IND AS 16.
Right. And AS 16 is the standard concerning property, plant, and equipment. We usually just call it PPE.
PPE, got it.
It basically builds the parameters for how a company recognizes, measures, and depreciates its physical assets. Factories, heavy machinery, land, the core infrastructure that actually makes them money.
And historically, companies just use the historical cost model, right? You buy a factory for $50 million, it stays on the books at $50 million minus depreciation. Forever.
Exactly. But IND AS 16 allows companies to use the revaluation model instead.
Okay, so adjusting it to current market value.
Right. Because if that factory is sitting on land that has tripled in value, keeping it at historical cost hides the company's true economic leverage. So they revalue it. And the difference between the old value and the new fair market value is what we call a revaluation surplus.
So it's an upward adjustment, an injection of unrealized wealth. But the standard setters know that if you let management just unilaterally increase asset values, they could manipulate their performance metrics, right?
Exactly.
Yeah.
Which is why you have to tightly control where that paper profit flows.
And that brings us to paragraph 39 of IND AS 16. I have the text right here. Let me read the critical rule.
Go ahead.
It says, if an asset's carrying amount is increased as a result of a revaluation, the increase shall be recognized in other comprehensive income and accumulated in equity under the heading of revaluation surplus.
That sentence is the architectural linchpin of our whole discussion today. The phrase shall be recognized in other comprehensive income. That is not a suggestion.
No.
It is an immutable mandatory directive.
And then there's the second half of paragraph 39, which is a specific exception. It says the increase goes to profit or loss only to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss.
Yes. What's fascinating here is the strict segregation of where the money goes. Let's talk about other comprehensive income, or OCI, for a second.
Yeah, please explain OCI because that confuses a lot of people.
So OCI essentially acts as a quarantine zone.
Quarantine zone.
Yes. Why does an unrealized paper gain on a factory go to OCI instead of your standard profit and loss statement? Because it prevents a company from artificially inflating its actual operational profit with random real estate fluctuations.
Okay, wait, I want to push back on that for a second.
Sure.
If the company is genuinely worth more because their land doubled in value, shouldn't the shareholders see that reflected in the bottom line immediately? I mean, the wealth is there.
I get that argument, but no. The OCI acts as a vital holding pen. You have to keep operational performance completely transparent and separate from asset valuation jumps.
Because operational performance is about their actual business model.
Right. If an entity manufactures turbines, the primary P&L should tell me exactly how good they are at making and selling turbines.
Ah, I see.
If we let them dump a massive real estate gain straight into their primary P&L, it contaminates the operational data. The headline earnings per share explodes, but it has absolutely nothing to do with their ability to build turbines.
That makes total sense. It creates a false positive for their actual business skills.
Exactly. So the rule is strict. It must flow through OCI first. It's a two-step process. Show it in the performance statement under OCI, then accumulate it in equity.
And what about that exception you mentioned, the reversal thing?
That introduces symmetry. If your asset dropped in value years ago and you took the hit in your primary P&L back then, the standard says it's only fair that when the value recovers, you can put the recovery back into the P&L, but only up to the amount you originally lost.
Anything above that historical loss goes straight to the OCI quarantine zone.
You got it. It's mathematically elegant.
It really is. Okay, so we've established this ironclad rule. We know how a revaluation surplus must flow. Now let's look at the actual accounting policy this specific listed company wrote down in their books.
This is where it gets wild.
It really does. According to the source text from the JAP Advisors Review, the company claims it recognizes the surplus from revaluation in a, and I quote, revaluation reserve directly presented in other equity.
Correctly presented.
Yeah.
That one phrase is a complete architectural failure.
They bypassed OCI completely.
They bypassed the mandatory flow mechanism entirely. By stating the surplus routes directly to other equity, they are skipping a mandatory step in the financial reporting chain.
Wow.
Therefore, their accounting policy is fundamentally not in accordance with IND AS 16. It's a direct violation.
This raises an important question, though. How does a publicly listed company publish an official accounting policy that directly contradicts the core text of IND AS 16?
It points to a massive breakdown in their technical review process. I mean, bypassing OCI reduces transparency for any investor analyzing the comprehensive income statement. You're effectively hiding the flow of wealth.
Here's where it gets really interesting to me. It's like, okay, think of it like a company trying to sneak a VIP guest straight into the penthouse.
The penthouse being...
Other equity.
Exactly.
Yeah.
They sneak them straight up the back elevator without making them sign the guest book in the lobby, which is the OCI.
That's a perfect analogy.
The standard demands that paper trail in the lobby for maximum transparency. You can't just materialize in the penthouse.
Right. And if you bypass the lobby, the final output lacks any verifiable provenance. It's structurally blind.
So a flawed written policy is bad enough, but as the Suomoto review discovered, the execution of that flawed policy reveals an entirely separate compounding error.
Yeah, the drafting error was just the beginning. Okay, so here is the second major bombshell from the source review. When you look at the actual other equity section of the company's statement of changes in equity, this OCE, there is no component of a revaluation reserve whatsoever.
None. It simply does not exist.
So what does this all mean for the listener looking at these charts?
It means we have a double failure. Not only did the company write a policy that violates IND AS 16, but they didn't even follow their own flawed policy when generating their tables.
They literally forgot to create the reserve they just wrote a policy for.
Exactly. And this brings in a direct violation of IND AS 1, which governs the presentation of financial statements.
Because it's not consistent.
Right. If we connect this to the bigger picture, IND AS 1 requires faithful representation. If your policy dictates the creation of a specific reserve line item, and your tabular data completely omits it, the financial statements fail the basic test of internal consistency.
So the Gap Advisors Review concluded they failed to comply with both IND AS 16 and IND AS 1.
Yes. Imagine reading a recipe that tells you to put the cake batter in a blue tin. But when you look in the oven, there is no blue tin at all. For an investor relying on the OCI to understand shareholder wealth, this kind of omission just destroys confidence in the data's accuracy.
It totally doesn't. Wait, this makes me wonder if they didn't put it in a revaluation reserve on this OCE. Where did the credit entry go? Double entry bookkeeping means it had to go somewhere. Did they just dump it into retained earnings?
That is the nightmare scenario for an auditor.
Why is that so bad?
Because retained earnings is the cumulative repository of realized distributable profits. If you put an unrealized paper gain like a factory valuation jump into retained earnings, you are artificially inflating your distributable reserve.
Oh, wow. Because you can only pay dividends from realized profits.
Exactly. You cannot pay cash dividends to shareholders based on a theoretical appraisal of your real estate. If the board relies on that inflated retained earnings figure to declare a dividend, they are effectively distributing capital illegally.
That is massive legal liability.
Huge. And it all stems from a single routing error and a missing line item on the SOCE. It compromises the fundamental data architecture the board relies upon.
This is exactly why getting these statements reviewed is so critical. We've explored the strict rules of IND AS 16 today regarding revaluation surplus. We uncovered a company policy that illegally bypassed other comprehensive income, and we found a glaring omission in the statement of changes in equity that violated IND AS 1.
It's a cascading failure.
And it really reminds us of the immense value of getting financial statements reviewed for IND AS compliance before signing them. Companies can submit their statements in near to publishing PDF format directly to GAAP advisors for this exact kind of rigorous suo motu review.
I highly recommend it. Internal teams get cognitive fatigue. They see what they expect to see. An independent reviewer like GAAP advisors spots the compiler error instantly.
Right. Get your financial statements reviewed by GAAP advisors before signing them. Just email the PDF to info@gapadvisors.com. And honestly, if you happen to invest in a listed company's shares, a review of their financial statements for IND AS compliance can totally help you make a proper decision on buying, holding, or selling.
Absolutely. It gives you a critical edge.
So, to everyone listening, please follow the GAAP Advisors IND AS Clinic channel on WhatsApp. You'll get updates on all videos, audio sessions, newsletters, new issues responded to, new standards issued. It's essential.
Continuous technical education is the only way to stay sharp.
And please, share this deep dive with your contacts. Send it to your colleagues, your audit and finance teams, and especially students pursuing their CA course. We have to spread the knowledge of Indian accounting standards.
Before we sign off, I want to leave you with one final thought to mull over.
Go for it.
If a listed company with all its massive resources, internal audit teams, and regulatory oversight can completely drop a required line item between its stated policy and its actual equity tables, what other unseen structural gaps might be hiding in the footnotes of the companies you currently invest in?
Oh, man. That is a chilling thought. It really forces you to reassess the baseline, doesn't it?
It certainly does.
Well, thank you so much for joining us for this deep dive. We really appreciate your time. Please don't forget to follow or subscribe to the GAAP Advisors IND AS Clinic on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen on.
Thanks, everyone.
Keep dissecting the structures, keep scrutinizing the matrices, and most importantly, keep questioning the numbers. See you next time.